Howdy, Jacob here. Today we're looking at Baker Hughes, company 104 in our generic stock screener. They are in the energy equipment and services industry, 32 billion market cap, 3 billion higher enterprise value. They provide a portfolio of tech and service to energy and industrial value chain worldwide. Founded in 2016. I think that's a little false since they have data prior, but I presume they've been around for quite some time. 2015 revenue was 17 billion, and now it's 25.5 billion. So you are looking at quite a bit of growth here, maybe mid single digits. So really not bad growth. Margins are down from 8 years ago, but have been averaging the upper single digits. Gross margin down from mid 20s to low 20s. Return on invested capital has historically not been super fantastic, but also earnings have been fairly volatile. Balance sheet shows 2.6 billion cash on hand with 148 million short-term debt, just under 6 billion long-term debt. So that debt has been going down of the last 4 years, but still sounds like a lot. So let's look what roughly 6 billion is in relation to cash flow. Okay, so maybe I could see that. Okay, if we average all that out, it's probably 4 to 5 years, less than 5 years, maybe more than 4, to dwindle all that debt, which is not a terrible concern, especially when a company has shown that they're willing to use some free cash flow to dwindle down that debt. So I think we should be fine if we allocate about 20 to 40%, depending on how we're feeling, of cash allocated towards debt reduction, which is really not going to go towards growth of the company, but it could just make the company more safe in the future, less liable on debt, and interest bearing. So I think that, with what we're seeing here, a little bit of money towards acquisition seems fine. A little towards share repurchases. The dividend of 804 million is 2.6%. That's a pretty hefty yield, and that's quite a bit amount of their free cash flow. So, I mean, I'd probably stick with that dividend being fine, as long as we see some growth. So let's start making some assumptions. I think that they're probably able, especially making a couple acquisitions here and there, to get to 4% growth. I don't think, however, they deserve really any sort of premium here, so I'm going to do slightly under market average at the end of 7 years. I'm going to bank on free cash flow more so maybe let's do 3 and 4 with share change of, even just 3% growth is not an immense amount, and they're currently paying out 800 million for this dividend, which again is a lot. That ratio of payout is going to decrease though year over year as we increase the revenue growth and the margins are similar-ish. So I'd maybe just offset their stock-based compensation with 200 million, and then that leaves a little bit of money to acquisitions and then a little bit of money to debt reduction. I think I feel pretty comfortable with these numbers, and we're saying the company still needs to fall 72% to get to the price we're looking for. So I will just be waiting until it gets to more, this might be a company I want to get at a really attractive price, because I don't think that numbers are screaming deal for me at this point. So hopefully you enjoy the video.